Well, today we talk about the elephant in the room. Could Kevin be right? Yes, that's the subject we're touching on today. And I put together kind of a whole presentation here on my 2 cents on this. Now, first off, before we get into that, the reason I'm doing this video is I've seen so many comments over the past couple weeks. And depending upon what happens in the market, there's kind of two types of comments. If the market goes up, I see a bunch of comments like, Kevin sold at the bottom, Kevin's an idiot, these sorts of things, right? And then when the market goes down a bunch, all of a sudden I see a lot of comments, ooh, Kevin was right, Kevin might be right, these sorts of things. So I thought, let's actually dive into this subject. It's kind of a taboo subject to talk about, I will say that, but I really want to talk about it. And first, let me just get this out of the way before I get into the economy and what's going on and stock valuations. And before we get into all that, let me just say this off the top. There's no winning for Kevin in this situation. If stocks go down a bunch, right, because he sold out of all his stocks, right, and if stocks go down a bunch, essentially he's in a situation, right, where he still looks bad because he's somebody of influence, and we try to never teach anybody to, pull out all sell out of all your stocks when the market gets tough, then try to time it out and get back in. That's like the one thing you're always kind of taught is don't try to time the market and sell out of all your stocks, then jump it back in the market. And, that's what we're always taught. So if the market goes down, he still doesn't win. And if the market goes up, he still doesn't win because then he just kind of looks bad in that situation as well, right? Where it's going to be like, Kevin, you sold out of all your stocks and look where the market went. Look where all those stocks went. Right? So it's kind of a no-win situation for him. But we can't deny the fact that he's made this bet on January 22nd, 2022. That's when he came out with that video, right? And since that time, at first, the market was going down. And this was that first stage of kind of like, oh, shoot, maybe he's onto something here. Then the market went up big time, right? NASDAQ, and I'm just looking at the NASDAQ here. Market went up big. Everybody was like, laughing at Kevin. Oh, you sold at the bottom, those sorts of things, right? Then the market fell a bunch. And then all of a sudden people were like, ooh, wait, maybe it's going to go back down. Then people were laughing again. And now today, people are like, I definitely saw some comments in my last video. It was like, oh, crap, maybe Kevin's right in this situation now that the stocks are back down again, right? And so, yeah, that's why we're doing this video, and we're going to really get into depth. Hope you guys enjoyed as always. I know it's a taboo subject, but every once in a while we got to touch a taboo subject on the channel, and today's that day. Make sure you subscribe to the channel, okay? So a day before, essentially, Kevin posted that video, he's selling all the stocks, I did a video. It was called I Am Preparing for Recession. And in that video, I go through, kind of why I'm preparing for recession. And although I don't know if there's going to be a recession or not, no one really knows, I have to be prepared for that sort of situation, right? And so there's kind of like two thought processes that you can kind of do in this situation. You could potentially sell out of all your stocks and those sorts of things. Or it's kind of like, let's say you think we might have war, right? You go hiding, or you can get the troops ready, right? And get the subs ready and get the tanks ready and get the planes ready and get ready in that sense, right? You don't know if the war is going to happen, but you're at least ready in that situation. If you sell out of stocks completely, then you kind of have already decided the war's here, right? You've already decided that. Where I'm kind of in the place of like, I want to be ready. So there's certain things I've done recently in my own life just to get ready in case something happens. Some of these would include setting up the public account, which has like, $1.4 million, setting it up. So if I ever wanted to margin money, I could margin money. I have $0 margined out on that account. Let me be very clear about that. But if we got into an actual crash in the stock market, at least I have some, a ton of capital ready there, right? Got a refinance going on a property, or essentially a cash out refi, so I can have a lot more money around just in case something happens. Pulled back expenses big time on Hungry Bull, and I'm also not spending any crazy money right now. You don't see me out there buying new cars right now, I'm not buying new watches, I'm not buying new homes, nothing like that right now. I pulled back on all those things. So I'm in a position where I feel like I'm ready just in case we go off the rails here and we were to actually have a crash. But it's a very different mentality than I'm going to sell out of everything, I'm going to cash out of everything. That's a whole different kind of decision than like I'm going to be ready and have some stuff ready just in case something happens, right? So first off, I think we have to address this. I can't always keep track of all the stocks Kevin was buying, but there's certain stocks I remember when we were talking Millennial Money that he did own. Okay, one of those was Affirm, and Affirm is down since he sold out, right? So at least as in the short term, he looks like he's made the right decision there. Affirm was, I would guess, 55, 60 range when he sold out roughly. Today, Affirm is $37 a share. That one is, falling quite dramatically. Right here, he was looking like it was a bad decision, right? He went up to 75 or maybe even above 75. But since then, it's down massively, okay? Next stock I remember him talking about a lot was this stock, Matterport, MTTR. This stock looks like when he sold out, it was in the $10 to $11 range. Well, today it's $6.50. So this stock's fallen about 40% just in the past few weeks, which is a crazy big drop, right? Tesla, we know this was his biggest holding in Tesla. I think he sold out somewhere around roughly 925-ish, roughly. Today the stock's 876. So he's looking good as far as that goes. The one last stock that I remember him talking a lot about was Enphase. Now, Enphase is not like those stocks. This one, it looks like he probably sold out maybe 125, 130 range. That's 148 today, okay? So nonetheless, I mean, if you're looking at least, and I don't know if he held more shares in certain stocks. I know Tesla was his biggest, and I don't know how many other stocks he held, but these are the four I remember him talking about on Millennial Money all the time. And so three of them, he's likely saved himself a lot of money so far. One of them, has gone up essentially since then, right? So if we go ahead and pull up the NASDAQ here, right now today we're at 13.7, so somewhere in that range. In order for you to want to sell out of all your stocks and maybe even potentially sell real estate, right, you have to be convinced the market's going to really crash, like bad, right? You can't make a decision like that if you feel like we're just going to go down 5 or 10%. You got to feel like it's going to be a massive drop. And so I don't think Kevin's gone out there to say what he's expecting the NASDAQ to go to or the S&P 500 or anything like that. But I'm assuming in his head, he's probably thinking we could drop anywhere between 7,500 and 10,000 on the NASDAQ, roughly, right? Because that's the only way it makes sense to even consider, I'm going to sell out of all my stocks. You can't do that if you're just planning on it being a 5 or 10% move. You got to feel like we're going to have a massive drop. If we dropped down to that range, let's say between 7,500 and 10K on the NASDAQ, we'd be back to kind of ranges we were at in 2016, 2018. And that's kind of how you got to look at it. If you think all we're dropping it is 12.5 and to sell out of all your stocks and sell real estate and all those things, you got to be pretty darn crazy in that sort of situation. You've got to assume we're going to go on a massive like 20, 30, maybe 40% drop in the markets, okay? So it's gonna take a lot to kind of get us down to those ranges. Now, I want to pull up the United States government debt. Obviously, you've heard a lot about the Fed and the pumping of money out there, and all the money that's been created in the last few years, essentially, right, through government programs. Whether it be straight stimulus checks, whether it be loans to businesses that weren't really loans that really you didn't have to pay back, whether that means paying for people to stay in their homes or to rent and not have to pay during that time. Whatever way you want to slice it, the government has pumped up the debt, okay? And they pumped a ton of money out there, right? $7 trillion essentially got added in the past 2 years to the United States government debt. Excuse me, did I say a billion? Did I say billion? I think I might have said billion. I might have to rewind this case. $7 trillion billion government debt. Okay. $7 trillion was added in the past 2 years. Before that, we went through an 8-year span where $7 trillion was added. And a lot of people say that's still an insane number, right? $7 trillion. So, when you pump that much money out there, it is important to remember that money doesn't just like disappear. That's in companies' hands now. That's in people's hands. And so it's not like that just disappears, right? In terms of real estate wealth, stock market wealth, crypto wealth, those sorts of things, that can be wiped out if you go through a major crash or something like that. But in terms of just this, money that's been pumped out there, that doesn't just magically go away. So there's a lot more money in the system now than we've ever seen at any point in history. And so I think that's very, very important to kind of keep in mind here, okay? Now, if you look at the United States government spending to GDP, right, which just kind of think about it as, the money government's kind of pumping out there versus what we're actually doing for the underlying economy, this is very, very key. So whenever you see this number go insanely high, United States government spending to GDP, it essentially means there's something dramatic had to happen bad in the overall economy. And so therefore, the government's doing something to try to help out the economy in a massive way. Think of it as a la pumping money, right? And so obviously we had this sort of situation in 08, 09 into 2010. And United States government spending to GDP went insane during that time. I mean, usually you should expect it to be somewhere between, 34 and maybe 38. We went all the way up to, the 42 to 44 range. Now, the same exact thing happened here recently where we've gone to about 44. So the government's been spending money left and right while the economy wasn't bringing in a lot. Now, keep in mind, this number's to 2020. They don't have the 2021 numbers quite finalized yet. From everything I've seen, those numbers should be out soon. And this number should have likely dropped, probably to down here, I would say, somewhere down here, in my opinion. But this is very key. So remember this. The government spends like crazy. Now, how does the stock market do after a scenario like that? Well, here was where the government spending to GDP went crazy, right? And meanwhile, we had a pretty darn good stock market over the coming years as that number went down and as the GDP just got better, right? And meanwhile, there was where we had the massive spending. So it's not like when that number goes down, right? As that was going down, where'd the stock market go? The stock market went up and up and up. And of course, it had some nasty dips here and there. On the long term, it doesn't look like anything. But believe me, if you were in the market, you felt these. You felt these dips in the market. It was pretty darn powerful. But ultimately, the market just went up and up and up over the coming years. And so the way to kind of think about it is the government is kind of like a parent of a teenager, essentially, okay? And if you have a teenager, they can kind of run their own life a little bit, right? They're not quite to an adult yet. They can't really make all the decisions. They're not really ready to run their life fully by themselves, but they're kind of like getting there, right? And so the government's kind of like a parent to a teenager, where when your kid kind of needs help with something as a teenager, you got to be there to help them through that situation or help them understand why this is this way or that way, right? And they're not quite ready to run their life on their own. And so very similar to how the Fed and the government reacts to the overall economy. When things get in a lot of trouble, guess what? Who comes to the rescue? The government, the Fed, whatever you want to call it, right? They're there to kind of save the day and kind of help the teenager, which is the overall economy, out of this situation. And that's what they're there for at the end of the day, right? To keep us on the kind of the right track so we can hopefully do as well as possible. And some people don't like that overall guidance, that kind of parent being in the room all the time. But you're not getting out of that situation. I just tell you that, right? Now, if we go back and we look at this, right? The last freak out we had in the market prior to Rona, which was, obviously February into March of 2020. The last freak out we had in the market prior to that was 2018. And especially late 2018, the market got really, really bad. Dow basically fell about 18.5% roughly off its all-time high. The SPY fell about, think of that as the S&P 500, fell about 20%, bear market. QQQ, NASDAQ fell 23%, bear market. And IWM, think of that as small caps, also went to bear market, 27% down. Now, if we look, the Dow hasn't been hurt that bad, and the SPY hasn't been hurt that bad. Now, it's still a pretty good amount in a short amount of time, 8.5%, 6.6%, but it's nothing even like close to what we had essentially in 2018, right? And so what this shows you is the largest of the large caps, the mega caps, those have been kind of holding the market together. Meanwhile, QQQ, IWM have felt the pain a lot. They haven't still felt it as much as we felt it in 2018. Now, it doesn't mean and by the way, IWM was down over 20% just a few weeks ago. We were in technically bear market for Russell, not that dang long ago, okay? But nonetheless, we could have further to fall, but just because we felt that pain back then doesn't mean we're absolutely going to feel that pain again, right? Double dip recession. Have you ever heard of the term double dip recession? A double dip recession refers to a recession followed by a short-lived recovery followed by another recession. One good indicator of a double dip recession is when gross domestic product GDP, which we just were talking about, growth slides back to negative after a few quarters of positive growth. Now, this is kind of what we're getting into in the market. You're not hearing this term too much yet, but get ready. You're going to hear this term likely a lot more over the next few quarters. You're going to hear this term double dip recession. You're going to go on CNBC. They're going to talk about double dip recession. You're going to hear hedge fund managers go on and talk about double dip recession. Believe me, it's coming, okay? And when this happens is when all of a sudden you get from, a really, really healthy GDP growing to all of a sudden falling. Look at this. This is from September of 2011 out of CNN Money. Forecasts say double dip recession is imminent. The U.S. economy is staring down another recession, according to forecasts by the Economic Cycle Research Institute. Quote, it's either just begun or it's right in front of us. The managing director of this said. But at this point, that's a detail. The critical news is there's no turning back. No turning back. We are going to have a new recession, they said, okay? Now, that's what was being said at the time, and because if you looked at what was happening with GDP, a lot of folks were coming to this conclusion that we are about to have a double dip recession. And what did the market do over this? The market kind of freaked out, okay? The market fell 20+% in a matter of 2 months. I mean, here, basically back in the summertime, this S&P 500 was trading 32.25, 32.50. Next thing you know, a couple months later, we're at 1,100, even under 1,100 there, right? 20%-ish fall in 2 months. I mean, it got ugly, and it got ugly really, really fast. And what ultimately happened is the stock market got really dramatic. There was a lot of fear out there. And what ended up happening is we didn't actually go into that double dip recession. We actually ended up climbing out, and everything ended up being okay. Now, keep in mind, during those years, 2011, even into 2012, GDP growth was not strong. We were not putting up 4%, 5% type numbers. It was not strong at all. We were putting up a lot of weaker numbers in the end. And this is what led to all these fears about double dip recession. Oh, we're going to have a double dip recession. And some were even going on, and they were talking about the double dip was going to be worse than the first dip, which the first dip was a disaster. And they were saying this double dip, it's going to be even worse than the first one. Just get ready, okay? And so, holy smokes, that ain't no jokers, right? Everybody was out there flipping their flapjacks, freaking out. I was buying stocks, but everybody was out there freaking out. And this is one of the reasons that Obama had to take, and the Democrats had to take that 2012 election very, very serious. No one ever heard of Mitt Romney before he ran for president. And here we were with the most likable president probably since JFK, or certainly since Ronald Reagan in the United States of America. And he actually had to take that election very, very serious. He took those debates extremely serious. They had to take the whole game really, really serious to Mitt Romney, who no one had ever heard of before that election. Like I guarantee you 90% plus of Americans never heard of Mitt Romney before that election. Here Obama was having to take that super serious because basically GDP was so weak for several quarters there that people were like, hey man, we need some economic growth. And what Mitt Romney ultimately ran on for the most part in that election was that he was the guy that was going to get us to 3, 4, 5, 6% GDP type growth, where, Obama, in the economy was having trouble putting up like 1%, 2% type numbers. And so ultimately that led to, them having to take that election very, very serious. And that's how it happens. If you put up weak economic numbers, believe me, all of a sudden somebody's waiting in the wings to take your place and say, hey, I got the path to real growth in this country. And that's what ends up happening, right? Now, for Kevin to be right in this situation, in my opinion, the economy has to go into a real recession, okay? That's in my opinion that for him to actually be right in this situation, because we're starting to run out of room for a lot of these stocks to move down. Could they continue to move down? Sure, but the moves are becoming so dramatic now that in order for these stocks to continue to tank, you got to have real economic deterioration in mass. And I'm talking about GDP really start to tank, right? If you look at these stocks, right? I just pulled up mega caps. These are mega caps. So these aren't even like, small caps and mid caps. That's a whole other situation there. Mega caps. You got Meta down 38% in the past 3 months. 38% for what is considered usually one of the top 10 safest stocks in the stock market. Shopify is down 61% in the past 3 months. 61% in 3 months on Shopify. PayPal. This would usually be considered a top 20, top 25 safest stock in the stock market. 47% in the past 3 months. That's extraordinary, right? I mean, these numbers are epic. Netflix down 43% in the past 3 months. Tesla, which is holding up pretty good, I guess you're going to say. Tesla down 20% in the past 3 months. ARK is down well over 50% in the past 1 year. Amazon 16% in the past 3 months. So these stocks are falling so much, a lot of these mega caps, that they start to lose room to fall more unless, this is a big unless, okay? Unless you really have GDP tank, spending really tank in a massive way, and then every single company really can't put up any impressive numbers for the next couple years because essentially like no one's out there spending money or something like that. So that's where you get into this kind of tough situation. You really need a recession to end up happening, right? Now, if we go ahead and look at this, inflation obviously is very, very key. And I know inflation and the Fed is part of, Kevin's thesis on why the stock market could go down a ton more, right? So if we go ahead and look at this, we essentially have 2 more months of tough comps for inflation. And when I say tough comps, it's basically a thought process that comes from being in stocks, right? And in the stock market, you have earnings every 4 quarters. And sometimes companies have really tough comps they have to comp against year over year, where they might have had an insane quarter the previous year and they have to comp against that tough number. And sometimes if they show a growth rate that's declining a ton because they have that tough comp, the stock can fall, right? And so essentially in inflation, you can have the same thing, right? And so essentially, if we go back to over a year ago or about a year ago, inflation, let's be honest, okay? In February 21, the inflation was way higher than 1.7%. That's a BS number. We were way higher than 2.6% in March of 21. Give me a break. That's a BS number. And honestly, in January 22, we're way higher than 7.5%. All these numbers are kind of BS numbers, in my opinion. That is my opinion, okay? But nonetheless, we have these 2 really tough comp quarters to comp against. And then the comps start getting easier and easier and easier because we already were on this massive incline in inflation, right? And so what I think is going to play out, this is my personal opinion, is I think the rate of inflation is going to start chilling way out, kind of, as we get closer and closer to summertime. And as we get into late this year, I've always been scared to say we're going to get into deflation. I'm very scared to say that. That's such a big prediction to try to say deflation. I don't want to go there, but I think inflation is going to get to much more normalized levels as we get past these 2 tough, quarters to comp against. Because in order to start seeing these numbers continue to go up 7-8%, you have to be up another 7 to 8% year over year. And that gets really, really tough in this scenario, right? And so, yeah, my thesis is as we go throughout this year, inflation will start to come down in terms of the rate of increase. And the fear around, oh my gosh, inflation continues to go up, we'll kind of get out of the market. But as of right now, because the percentage keeps going up, that's what's freaking out the market in a massive, massive way. And we kind of saw this freak out really starting in November. And guess what? Inflation really ticked up there. Then it continued to tick up in December, continued to tick up in January. Everybody's expecting February to potentially be, I'm hearing a lot of people expecting like an 8% type number, maybe over 8%. So yeah, as long as you're on this kind of trajectory, which we're probably going to be on for another 1 to 2 months, it makes it really, really tough in the market because people just think inflation's out of control, right? But after we get off that, we'll see the growth rate start to, in my opinion, chill out a bit, okay? Now, keep this in mind because I know, a lot of the fear is around the Fed, especially when it comes to Kevin. And, he talks about obviously Jay Powell, being our friend or our enemy. And I mean, if we look at rate hike cycles, it's usually a good thing for stocks overall when you look at these, right? 99, 2001, obviously we fell, but that was really because of the tech bubble more than rates going up in that situation, right? 04 to 07, market did good. This one's a little bit of a fabricated number Market Watch put out here. Rates really started to go up in 15 to 19. So, the 442% for the NASDAQ, that's a little BS in my opinion, but you can't deny that when rates started to go up from 2015 and 19, the stock market did do good during that period. The Dow did good, the S&P 500 did good, the NASDAQ did good, the Russell did good, everything, pretty much did good during that time period. So that's something very important to keep in mind here, okay? So in my opinion, I think the only way Kevin could really be right in this situation is if we really get a true recession that really takes the economy down, housing prices start coming down massively, right? We get spending to dry up. And if you get in that environment, absolutely, we can end up in a stock market crash. At the end of the day, I think the Fed is, they're definitely not perfect, but, they're pretty darn good at what they do. And I know they get crap when the market gets rough, but generally speaking, they kind of know what they're doing. And, it's tough to make those sorts of decisions. So yeah, time will kind of tell how all the situation plays out. As I've said before, I don't think it's, for him personally, it's like a no-win situation. But in terms of the market, I stay ready. And if we get any massive dips, I got stuff ready for those massive dips. If they come, if they don't come, that's perfectly fine. But it's really going to come down to the underlying economy, in my opinion, much more than it's going to come down to inflation, and much more than it's going to actually come down to the Fed. So let me know in your guys' opinion in that comment section. I hope you guys enjoy this. As always, make sure to subscribe to the channel if you're not already subscribed. And if you want some free stocks from Moomoo, check out pinned comment down there. They're even giving away a free TTCF share right now with a $100 deposit. Much love as always, and have a great day.